Welcome to Booked for Wealth, where your financial success starts here. We're exploring the best finance books to help you build wealth and achieve your goals. Comment below about what book you want reviewed next. Every review is packed with insights to fuel your journey toward financial freedom. So go ahead, hit that subscribe button, and join our community. Together, we'll turn your financial dreams into reality. Let's jump into the Booked for Wealth review, The Intelligent Investor by Benjamin Graham. The Intelligent Investor by Benjamin Graham is often hailed as the ultimate guide to value investing, a must-read for anyone who's serious about making smart investment decisions. Whether you're new to the world of investing or have been at it for years, Graham's teachings provide a solid foundation that can help you navigate the often unpredictable stock market with confidence and discipline. First published in 1949, this book has stood the test of time, influencing countless investors, including some of the most successful ones, like Warren Buffett. So, what makes this book so special? At its core, The Intelligent Investor is about taking a thoughtful, strategic approach to investing. Graham doesn't promise quick riches or shortcuts to wealth. Instead, he focuses on the long game, emphasizing the importance of patience, discipline, and a deep understanding of what you're investing in. He introduces concepts that are not only practical but also grounded in common sense, ideas that are just as relevant today as they were over 7 decades ago. One of the first things Graham does is distinguish between two types of market participants, investors and speculators. According to Graham, an investor is someone who makes decisions based on thorough analysis and who seeks to ensure the safety of their principal while earning a satisfactory return. A speculator, on the other hand, is more concerned with short-term gains and often takes on higher risks in the hopes of hitting it big. Graham's advice? Be an investor, not a speculator. It's a simple distinction, but it's one that forms the foundation of his entire philosophy. Mr. Market and the margin of safety. One of the most memorable concepts in the book is the character of Mr. Market. Graham uses this metaphor to illustrate the stock market's often irrational behavior. Imagine that Mr. Market is your business partner, and every day he offers to buy your shares or sell you his at varying prices. Some days he's optimistic and offers a high price, and other days he's pessimistic and offers a low one. Graham's point is that you don't have to accept Mr. Market's offer. Just because he's moody doesn't mean you have to be. Instead, use his irrational behavior to your advantage, buy when he's pessimistic and sell when he's optimistic. This concept teaches investors to remain calm and rational, even when the market is anything but. Another cornerstone of Graham's philosophy is the margin of safety. This principle is all about protecting yourself from the risks that are inherent in investing. Essentially, it means buying securities at a price significantly below their intrinsic value, so that even if things don't go as planned, you have a buffer to protect your investment. The margin of safety is a key reason why Graham's approach is considered conservative. He's all about minimizing risk and preserving capital, rather than chasing high returns. Defensive versus enterprising investors. Graham also categorizes investors into two broad types, defensive and enterprising. A defensive investor, also known as a passive investor, is someone who wants to minimize risk and effort. They prefer a simple, low-maintenance approach to investing, typically by diversifying their portfolio with high-quality stocks and bonds and holding onto them for the long term. Graham's advice for defensive investors is to stick to what works, invest in stable, well-established companies, avoid the temptation to time the market, and focus on consistency rather than high returns. On the other hand, the enterprising investor, or active investor, is willing to put in more time and effort to achieve potentially higher returns. This type of investor is more hands-on, actively searching for undervalued stocks, analyzing financial statements, and making adjustments to their portfolio based on market conditions. However, Graham cautions that being an enterprising investor requires a significant commitment of time and energy. It's not for everyone, and it's definitely not a path to be taken lightly. He emphasizes that while the potential rewards can be higher, so too are the risks. Stock selection and analysis. When it comes to choosing stocks, Graham's advice is rooted in fundamental analysis. He provides clear, practical criteria for evaluating stocks, such as looking at a company's earnings stability, its dividend record, its financial strength, and its price-to-earnings ratio. He encourages investors to focus on companies with a strong track record and solid financials, rather than getting swept up in hype or speculative trends. Graham's approach is methodical and data-driven. He's a firm believer that the stock market is not a place for gambling, but rather a place where careful, rational decisions can lead to steady, long-term wealth creation. He urges investors to think like business owners, buying shares of companies that they would be comfortable owning outright if they could. This mindset helps investors focus on the intrinsic value of their investments, rather than getting caught up in the day-to-day fluctuations of the market. The role of bonds in a portfolio. Graham also stresses the importance of bonds in an investment portfolio, particularly for defensive investors. Bonds provide stability and a steady income stream, helping to balance the more volatile nature of stocks. He discusses different types of bonds, such as government bonds and corporate bonds, and offers advice on how to allocate assets between stocks and bonds based on factors like market conditions and an individual's risk tolerance. For Graham, the key to successful investing is balance. He advocates for a diversified portfolio that includes both stocks and bonds, allowing investors to benefit from the growth potential of equities while also enjoying the security and income that bonds provide. This balanced approach helps to protect against the uncertainties of the market and provides a more stable path to wealth accumulation. The psychology of investing. While much of The Intelligent Investor is focused on numbers and analysis, Graham doesn't overlook the psychological aspects of investing. In fact, he spends a significant amount of time discussing the importance of emotional discipline. Graham is keenly aware that even the most well-thought-out investment strategy can be derailed by emotions like fear and greed. He warns against the dangers of following the crowd, getting swept up in market euphoria, or panicking during downturns. According to Graham, the most successful investors are those who can remain calm, rational, and independent in their thinking, regardless of what the market is doing. Graham's advice on maintaining emotional stability is as valuable today as it was when he first wrote the book. In an age where information is abundant and market movements are broadcast 24/7, it's easy to get caught up in the noise. But Graham reminds us that successful investing requires a long-term perspective and the ability to tune out short-term volatility. It's about staying the course and not letting temporary setbacks or opportunities cloud your judgment. Strengths. Timeless wisdom. One of the book's greatest strengths is its timelessness. Despite being written over 70 years ago, the principles Graham discusses are just as relevant today. The core ideas of value investing, risk management, and emotional discipline are universal and have helped countless investors build and preserve wealth over the years. Practical and actionable advice. Graham's writing is clear and practical. He doesn't just present theories, he provides actionable strategies that investors can apply in their own portfolios. Whether you're evaluating a stock or deciding on an asset allocation, the book offers concrete steps that make complex concepts accessible. Focus on risk management. Graham's conservative approach is all about managing risk. He's more concerned with protecting your capital than chasing high returns, which makes his advice particularly valuable for those who want to build wealth steadily and safely. Insight into investor psychology. Understanding the psychological side of investing is crucial, and Graham does an excellent job of highlighting the importance of emotional control. His advice on how to avoid common psychological traps is invaluable for anyone looking to make sound, rational investment decisions. Adaptability for different investors. Graham recognizes that not all investors are the same. By differentiating between defensive and enterprising investors, he provides tailored strategies that cater to different levels of risk tolerance and commitment. Endorsement by industry giants. The fact that investing legends like Warren Buffett consider The Intelligent Investor to be a must-read speaks volumes about its credibility and impact. This book isn't just theoretical, it's been applied successfully by some of the best in the business. Weaknesses. Outdated examples. Given that the book was first published in 1949, some of the examples and references might feel a bit dated. The financial world has changed significantly since then, with new investment vehicles and market conditions that Graham didn't address. However, many editions of the book include updated commentary to make the content more relevant to today's readers. Complexity for beginners. While Graham does his best to explain concepts clearly, some sections can be quite dense, especially for those who are new to investing. The language and financial jargon may require some effort to fully understand, which could be a barrier for beginners. Limited discussion of modern instruments. Because the book was written so long ago, it doesn't cover modern investment vehicles like index funds, ETFs, or derivatives in much detail. These tools have become quite popular in recent years, and investors interested in them might need to seek out additional resources. Emphasis on individual stock picking. Graham's approach heavily focuses on analyzing individual stocks, which might not be practical for everyone. In an era where passive investing through index funds is gaining popularity, some readers might find his strategies less applicable to their needs. Real-life applications. Long-term investment strategies. By applying Graham's principles, investors can build portfolios that prioritize long-term stability and growth over short-term gains. His advice is particularly useful for retirement planning and wealth preservation. Risk mitigation. The margin of safety concept is a powerful tool for reducing risk. By buying securities at a discount to their intrinsic value, investors can protect themselves from market downturns and make more conservative investment decisions. Emotional discipline. Graham's teachings on emotional control are crucial for navigating the ups and downs of the market. By staying calm and rational, investors can avoid making impulsive decisions that could harm their portfolios. Investment analysis skills. Graham's detailed methods for evaluating stocks and bonds can help investors develop their analytical skills, enabling them to make more informed and effective investment decisions. Tailored investment approaches. The distinction between defensive and enterprising investors allows readers to choose strategies that align with their personal goals, risk tolerance, and time commitment. Educational foundation. For those looking to deepen their understanding of investing, The Intelligent Investor provides a solid educational foundation. It's a great starting point for further study and can serve as a reference guide throughout one's investment journey. Conclusion. The Intelligent Investor is a timeless classic that has rightfully earned its place as one of the most important investment books ever written. Benjamin Graham's emphasis on value investing, risk management, and emotional discipline offers a comprehensive guide for anyone looking to build and preserve wealth over the long term. While some of the content might feel dated, and certain sections may be challenging for beginners, the core principles of the book remain universally applicable. Graham's teachings have guided some of the world's most successful investors and continue to provide valuable insights for both novice and experienced investors alike. Whether you're just starting out in the world of investing or are looking to refine your strategy, The Intelligent Investor is a must-read. It's a book that will not only help you become a better investor but also encourage you to approach investing with patience, discipline, and a rational mindset. In a financial world often driven by speculation and short-term thinking, Graham's wisdom serves as a steadying force, reminding us that true investing success is built on careful analysis, sound principles, and a long-term perspective. If you're ready to take control of your financial future and invest with confidence, The Intelligent Investor is the guide you've been looking for. It's a book that has the power to transform the way you think about investing and, ultimately, to help you achieve lasting financial success. 5 favorite quotes from The Intelligent Investor. The Intelligent Investor is a realist who sells to optimists and buys from pessimists. This quote encapsulates Graham's philosophy of staying rational and taking advantage of market emotions rather than being swayed by them. The essence of investment management is the management of risks, not the management of returns. Graham emphasizes the importance of focusing on minimizing risks rather than chasing high returns. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. This quote highlights the difference between short-term market fluctuations driven by sentiment and long-term value based on fundamentals. The margin of safety is always dependent on the price paid. Graham's core principle, the margin of safety, is about buying investments at a significant discount to their intrinsic value to protect against uncertainty. Those who do not remember the past are condemned to repeat it. This reminder from Graham encourages investors to learn from market history to avoid repeating mistakes. For things to remember, focus on value, not price. Always assess the intrinsic value of an investment rather than getting caught up in market prices or trends. Be patient. Successful investing requires a long-term perspective. Don't be swayed by short-term market noise or emotional reactions. Manage risk first. Prioritize preserving your capital by investing with a margin of safety and avoiding unnecessary risks. Stay disciplined. Stick to your investment strategy and avoid speculative behavior, even when others are chasing short-term gains. 3 things to stop doing. Stop speculating. Avoid making investment decisions based on short-term market movements or trying to time the market. Stop following the crowd. Don't let market sentiment or herd behavior dictate your investment choices. Make decisions based on thorough analysis. Stop ignoring fundamentals. Focus on the financial health and long-term prospects of companies rather than getting distracted by hype or trends. 2 things to start doing. Start analyzing investments thoroughly. Take the time to perform in-depth research and analysis before making investment decisions, focusing on the company's fundamentals. Start balancing your portfolio. Diversify your investments across different asset classes to reduce risk and achieve a more stable return over time. 1 thing to do every day. Maintain emotional control. Practice staying calm and rational in the face of market fluctuations. Make it a habit to approach investment decisions with a clear mind, free from the influence of fear or greed. Thanks for tuning in to Booked for Wealth. Remember, the knowledge you gain today is the wealth you build tomorrow. If you found value in this review, make sure to like, share, and subscribe. Stay connected with us for more insights, strategies, and inspiration to keep your financial journey on track. Until next time, keep growing, keep thriving, and let's make your financial dreams a reality.